Most people lose money in the markets not because they lack intelligence, but because they lack patience. They chase quick gains, panic at every dip, and sell the moment things get uncomfortable. The result? They walk away with less than they started with. The truth is, the biggest fortunes in history were never built overnight. They were built quietly, carefully, and over many years. Long-term thinking is not just a strategy. It is the single most powerful advantage anyone can have in finance, and today, this script breaks down exactly why. The trap of short-term thinking. Every generation falls for the same trap. When markets move fast, people want to move faster. When a stock is climbing, they rush to buy. When it drops, they rush to sell. This cycle repeats endlessly, and for most people, it ends the same way, in regret. Short-term thinking feels smart. It feels active and in control. Checking portfolios every hour, reacting to headlines, chasing the latest trending stock, it all gives the illusion of progress. But in reality, that constant movement destroys wealth instead of building it. The data tells a stark story. The average holding period for a stock has collapsed over the decades. In the 1950s and 1960s, investors typically held stocks for 8 to 10 years. Today, that number has shrunk to just a few months. Meanwhile, the gap between what the market returns and what the average investor actually earns continues to grow wider. The reason is simple: people keep selling at the wrong time. Take the story of someone who invested in the S&P 500 in 2008, right before the financial crisis. If that person panicked and sold during the crash, they locked in devastating losses. But anyone who held on and did nothing saw their investment not only recover, but multiply several times over in the decade that followed. The market rewarded patience. It punished fear. Short-term thinking also comes with hidden costs. Every trade generates taxes and fees. Constant buying and selling chips away at returns in ways people rarely notice until they look at the final numbers. Long-term investors avoid most of these costs simply by staying still. Understanding this trap is the first step. The second step is learning from the people who mastered the alternative. The power of compounding and the proof in real lives. There is one force in finance that Albert Einstein reportedly called the eighth wonder of the world: compound interest. It sounds simple. Earnings generate more earnings. But the actual effect of compounding over long periods of time is almost impossible to grasp until the numbers play out in real life. Consider this: a business growing its value at 15% annually will roughly double every 5 years. Over 17 years, that same business becomes 10 times more valuable. The longer the timeline, the more dramatic the transformation. But here is the catch: compounding only works if the investor stays in the game long enough to let it happen. Warren Buffett is the most celebrated example of this principle in action. He began buying stocks at the age of 11 and spent the next 8 decades doing what most people cannot: holding on. Through wars, recessions, market crashes, and global crises, he stayed invested. The result was Berkshire Hathaway compounding its value at roughly 20% annually for over 6 decades, generating a total return that most people would not believe without seeing it written down.
I think ever since I described it that way, in terms of I talked about in terms of the probabilities that they would dominate the soft drink market and not lose market share in any way, that they would grow over time.
Buffett's approach to Coca-Cola illustrates this perfectly. He purchased around $1 billion worth of Coca-Cola shares in 1988 and held them for over 30 years. That original investment eventually grew to more than $20 billion in value, while the company also paid him hundreds of millions in annual dividends. The same logic applied when he invested billions into Goldman Sachs and General Electric during the 2008 financial crisis, when everyone else was running for the exit. While others saw collapse, Buffett saw opportunity because he was thinking in decades, not days. Jeff Bezos once asked Buffett why more people did not simply copy his strategy, given how straightforward it seemed. Buffett's reply cut straight to the heart of the matter. He said that nobody wants to get rich slowly. That one line explains almost everything about why short-term thinking dominates despite long-term thinking clearly winning. Bezos himself applied similar thinking to Amazon. The company operated at a loss for years while Bezos continued to reinvest everything back into the business. Wall Street pressured him constantly. Analysts questioned whether Amazon would ever be profitable. Bezos ignored all of it and kept building. That long-term conviction transformed what started as an online bookstore into one of the most valuable companies ever created. Elon Musk followed the same pattern with Tesla. In the early years, Tesla was mocked, shorted aggressively, and written off by major financial institutions. Musk personally borrowed money to keep the company alive at certain points. But the long-term vision held steady. Investors who believed in that vision and held through years of doubt and volatility were eventually rewarded enormously as Tesla's valuation reached levels that once seemed absurd. These stories share a common thread. None of these outcomes were possible without the willingness to think beyond the next quarter. How to build a long-term financial mindset. Knowing that long-term thinking works is one thing. Actually applying it is something else entirely. The financial world is designed to pull attention toward the short term. News cycles, social media, trading apps, everything moves fast and creates urgency. Building a long-term mindset requires deliberate, consistent effort against that current. The first principle is simple: invest in what is genuinely understood. Buffett spent decades avoiding technology stocks, not because he doubted technology, but because he did not feel he understood the businesses well enough. When he finally invested heavily in Apple, it was not because of a short-term earnings report. It was because he understood the power of Apple's brand and the deep loyalty of its hundreds of millions of users. That investment became one of the most profitable in Berkshire Hathaway's history. The second principle is to treat market downturns as opportunities rather than threats. Every significant crash in market history, 1987, 2001, 2008, 2020, eventually reversed, every single one. Investors who added to their positions during those downturns were rewarded. Investors who sold were not. Volatility is not the enemy of the long-term investor. It is the mechanism through which great opportunities are created. The third principle is to eliminate financial noise as much as possible. Checking a portfolio daily creates anxiety that leads to poor decisions. The more frequently someone looks at their investments, the more likely they are to react emotionally. Long-term investors check in periodically, not obsessively. They measure performance in years, not weeks. The fourth principle is to build financial habits that remove decision-making from emotion. Automated savings, consistent contributions to retirement accounts, and a commitment to never selling during a panic, these structures protect investors from their own worst instincts. The goal is to make long-term behavior the default, not the exception. Finally, the greatest long-term investment anyone can make is in their own knowledge. Buffett famously reads for several hours every day. Bezos structures entire weeks around thinking and learning. The people who build the most wealth over time are not necessarily the fastest or the most aggressive. They are the most informed and the most patient. They understand that finance rewards those who think in lifetimes, not market cycles. The markets will always fluctuate. Headlines will always sound alarming. There will always be a reason to panic and a reason to wait. But the investors who have built lasting wealth throughout history all share one trait. They resisted the noise. They trusted the process. And they gave time the chance to do what it does best: turn patience into prosperity. The clock is always ticking. The question is whether it is working for someone or against them. Choose long term. Choose to let time be the most powerful asset in the portfolio.